Flexible targeting refers to basically changing the fiscal deficit target according to changes in the circumstances of a country. That is only one definition of flexible targeting when you have a country like India, which has many states, which are in very different economic circumstances. So, if you take a state like Kerala, you could argue that because Kerala has 3 times the per capita income of UP, its capacity to absorb debt is higher than UP. If that is true, then you could have a flexible target for Kerala, except that when your per capita income goes up, you would also expect tax revenue to go up. Kerala's own tax revenue performance is not very good. While it does devolve significantly more resources to local authorities than other states, there's a lot it could do in that direction. Similarly, one could argue that Kerala's need for infrastructure finance is actually lower than UP's. And so, if you're borrowing essentially for public investment, then Kerala has both the ability to attract private sector investment, not just in infrastructure, but also in education, health, etc. And its infrastructure needs are not as dire as that of UP, which cannot in fact attract private investment. So, priority for public investment should be given to poorer states. If that is the argument, then actually UP would get a more relaxed fiscal deficit target than Kerala. Therefore, there is no clear open and shut answer to this question of should we adopt flexible targeting. If you look at international experience, then the best way in which flexible inflation targeting is maintained is when you have a technocratic body such as you have in the UK or in the independently in the Congressional Budget Office in the US or in Australia, that tells you what the implications are of running a given level of fiscal deficit or incurring a given level of debt. Once they tell you what the fiscal implications are and that information is put in the public domain, there is a discussion and then the government does something for which it is held accountable if it does not achieve results. Final thing I want to say about flexible targeting is that there is a huge argument to be made that flexible targeting options should be given to states that complete what they set out to finish, to what they embark on doing. As Keynes once said, if you can do it, you can afford it. So, if a state is poor at executing capital expenditure, then the business case for giving it flexibility is limited. If a state is good at executing capital expenditure, then the business case for it getting a flexible target, a different target, is high. So, that is another consideration that comes into the question in this matter. But unfortunately, in India, our FRBM is very top down. It's framed in Delhi, implemented from Delhi with the view that Delhi takes of different states. That needs to change, and if that changes, I think what you will get is more flexibility in the conduct of fiscal policy, including deficit targeting, and not imposed rules that sort of grant you flexibility, as is presently the case. So, for young people venturing on a career in economics more generally, public finance has the following attractiveness. You can work in a variety of areas. You can of course work for the government of India and the Reserve Bank of India, but then they have other economists. You can work in a think tank like GIFT or NIPFP, but so can other economists. You can also work in the World Bank and the IMF because they have a fiscal affairs division or any multilateral bank. And Indian private sector is always looking for people, especially financial sector, who have skills in public finance. So, what a career in public finance does is it gives you interoperability. However, you must not claim to be a public finance person and end up being a public finance accountant. There is no demand for public finance accountants. Therefore, unfortunately in public finance, what you need is also good economic and econometric skills, of course, but also a solid understanding of political economy, because finally public finance is about the state, how the state spends money, how the state gets money. And a clear understanding of that requires an understanding of politics to a much greater extent that you would need as a labor economist or a macroeconomist. So, with that caveat, my advice to you would be, of course, learn your math and learn your data, learn your politics also, and understand that a career in public finance is most rewarding when it's an applied career. It's not purely academic. There are lots and lots of applied opportunities, and the door is revolving. I myself started life as an academic, Then I worked for the multilateral institution. Then I came back as director of NIPFP, right? And then I went back to academia. So it's possible to switch sectors if you have a public finance background in a way that few other sub-disciplines of economics offer.